and welcome to our next NAP. NAP stands for Nonprofit Auditor Points, and I'm Irina Oshkova, your nonprofit auditor. NAPs are designed for management, board members, accountants, and bookkeepers of nonprofit organizations. Hopefully, you will find this information helpful. Today, I want to talk about how to test investment accounts from the auditor standpoint. And even if your nonprofit is not going to go through audits, these hints and information will be very useful for your nonprofit because the procedures that we as an auditor perform and information that we're asking for, your nonprofit have to have regardless whether or not you go through audit or financial review. So please listen, and hopefully it will help your nonprofit to improve your policies, procedures, and overall recording of investment transactions. So what are investments? Nonprofits very often invest in certificate of deposits, bonds, stocks, mutual funds, and so forth through various financial institutions. Why? Because a lot of times nonprofits have extra cash and they do not want to keep money just in a bank account or saving account. Not only they don't want to, it's not advisable because FDIC, which is federal insurance, provides only insurance up to $250,000, and it's not a good idea to keep a lot of cash just on a regular bank account. So investment accounts can be quite secure, provide very little risk, but also provide some financial return on investments, dividends, interests, and this way nonprofit can put aside some money from the bank, from the cash. Also, very often nonprofit might have board designated funds or endowment funds that have to be kept separately from regular cash accounts because they're not available for day-to-day operating activity. So investment accounts are served as a cushion or preservation of some extra funds that organization is saving for later use or for specific purposes. Therefore, nonprofit purchasing some investments. And before nonprofit purchase investments, nonprofit needs to make sure that it has investment policy where it's outlined what kind of investments are allowed and what is the purpose for these investments. Investments are one of few accounts in the United States where we as accountants have to keep based on fair market value, meaning that investments can be appreciating or depreciating every month, and we have to record either when investments increase the value, we recognize unrealized gain. When investments decrease in value, we have to recognize unrealized loss. So if investment sold, then we do recognize realized gain or loss. But if it's not sold, but simply value go up and down, if it's up, it's unrealized gain. If it's down, it's unrealized loss. One area where we notice very often that some nonprofits record unrealized gain or loss, bypassing income statement and recording directly to net assets. That's not a proper way to record unrealized gain loss. Any changes in investment activities such as interest, dividends, realized gain loss, and unrealized gain loss, all of them should be recorded on a statement of activity or profit and loss statement or income statement, whatever name you use, but they need to be recorded in your statement of activity for the year. Preferably, we will all call it investment on return on investments. Again, realized gain loss, unrealized gain loss, interest, and dividends. Hopefully your nonprofit have all four types of accounts where you record that return on your investment activities. For nonprofits, investments and for profits for that matter, investments are classified on 3 different levels. And depending how reliable value of investment is, how easily to obtain value of the investment. For a lot of nonprofit organizations, we prefer, readers and donors prefer nonprofits to invest in level 1 type of investments. Why? Because level 1, meaning that it's easily to obtain the value of the investment, because investment is traded in the public markets, and if you own, for example, stock of publicly traded company, you know the value of that stock any given point of time, and it's pretty reliable value. Therefore, level 1 of investments, it's very reliable value of the investment. Okay, so we indicated if your nonprofit have investments, your nonprofit must have policies and procedures. Decide where the money will be invested, why, and what is the purpose of these funds. Every investment should be decided how this money going to be used. If you're putting aside funds for next year and you're planning to dig in that funds, or if need might arrive, you might sell investment, that's going to be short-term investments, because typically classification of investment depends on the management intent, what you're planning to do with investment. But if your nonprofit really planning to put this money aside for a long period of time and definitely not use it in a period for the next 12 months, it needs to be classified as a long-term investment. For all investments, regardless if not your nonprofit made additional contribution or distribution from that investment account, you need to obtain statements, and same as a cash accounts, your bookkeeper needs to perform bank reconciliation for all investment accounts monthly. The idea is the same. You need to make sure that the amount of investments on your bank agree with investment on the your financial from your investment account. Again, each investment account will have unrealized gain lost every month. There's might be dividends and interests and other fee, maybe brokerage fees recorded every month. These transactions needs to be recorded and reconciled for every investment account. It should not be an option. In investment accounts, same as very similar to cash, can be easily manipulated. Stolen is considered risky accounts. Therefore, the best practices for nonprofits to perform reconciliation for investment accounts monthly within 15 days after each month's end. And make sure that in return on investments, including interest, dividends, realized gain loss, unrealized gain loss, properly recorded. It's also a good idea for the management to see how your investment performs. How much is there realized and unrealized gain, loss, interest, and dividends, and maybe talk to your financial advisor or maybe finance committee within the board to see if your composition of investments might need to be changed, or just to make sure that you investing in accordance with your investment policy. So why also very critically to keep your investment return on investment account separately, for example, like interest, dividends, realized gain loss, unrealized gain loss. It also will help your management board to analyze what's going on. If you really see a lot of unrealized loss, you might actually decide to change investment. There could be a lot of reasons. Again, good idea to keep track of all the very different type of investment return, interest, dividends, unrealized, realized separately. Right. And another very common area for nonprofits is to have either board designated funds or even endowment funds. If we would advise if your nonprofit has either board designated funds or endowment funds, keep those funds as separately invested, especially if you have endowment funds. There is special management of endowment money to make sure that they do not go below the corpus. Make sure that you track earnings on endowment funds separately. Therefore, it's very advisable for endowment funds to have their own investment account. Make sure that it's tracked separately, accounted separately, and reported separately. So if your nonprofit has endowment funds or board designated funds or quasi-endowment funds, account them, create a separate investment account for these type of funds, so they're not commingled with your operating investments or other investment accounts. Just to conclude, investment accounts could be very material for many nonprofits because they're used as a saving mechanism or mechanism for allocating funds for specific purposes. Therefore, treat your investment accounts very carefully, even though they're not as often used as your cash accounts, but they still need to be reviewed, reconciled monthly, and reviewed by board and management monthly. Make sure there is no funny transactions are going on inside investment accounts. Earnings or changes in investments that include dividend, interest, realized gain loss, unrealized gain loss, and other fees needs to be accounted separately so management can analyze what is your return on investment, what is unrealized fluctuation in the account, and what were fees on the account. And lastly, please do not forget that unrealized gain loss is also considered income and should be recorded together with the rest of realized gain loss together in the same statement, not in the net asset section of the balance sheet. That's not the correct treatment of unrealized gain loss. And lastly, if your nonprofit has any board designated funds, endowment funds, or quasi-endowment funds, make sure that they are treated separately in investment associated with these net assets, invested in separate investment accounts, because you want to make sure that you separate earnings from board designated investments in endowment funds are separate from regular investment accounts that nonprofit has that potentially can be used for your operating activity. They're different purpose and they need to be accounted differently, separately. Thank you so much. Thank you for being here with me today. Looking forward to see you for our next NAP where we're going to discuss what do we test, how do we test another audit area. Thank you so much. Be safe.